All right, good afternoon, ladies and gentlemen. What we are going to do today is set up a chart with some indicators and kind of understand how to read the chart. So it's your boy, Robert Williams, on IG, the emotional trader, because this is an emotional game sometimes, but the objective is to trade without emotions. So the emotional aspect is to be non-emotional. But we have up here right now ThinkorSwim on this trading platform. And so what I'm going to do is what we're doing is we're looking at the Dow Jones. And I have a few settings already on my ThinkorSwim platform, but what we're going to do is set it up with, let's start with setting it up with some Bollinger Bands. So again, as I mentioned, we have the Dow Jones here, and with ThinkorSwim, what we can do is we can go to our studies tool. There's two sections, there's studies here and studies here. But we can go to our studies tool and we can add quick studies, right? Or add different studies, such a large list of different studies and things of that nature that are on ThinkorSwim. Or we can go ahead and edit the existing study and then just add stuff to it. So the existing study or chart setting that I'm on right now is a no EMAs. So meaning it has nothing on it and nothing but the candlesticks, and all it has is the volume. So what we're going to do is edit this study. And as I mentioned, let's go ahead and do a Bollinger Band study. So I'm gonna type in Bollinger Bands and we're going to add that selection. And we see that it popped up here with the simple. And so we can edit our Bollinger Band settings. And editing our Bollinger Band settings, it gives you the inputs and the options that are available to you, to where the price is going to be based off the closing price of the day. You can have it based off the open price, high, low, blah, 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 blah. But of course, you want to know what it's going to be at the close. Displacing, we're not going to displace it off the chart. So we don't want it to be up or down by any particular means. The length will be 20. So this is going to be based off and we can hit this box here, is the number of bars used to calculate the moving average and standard deviation. So we're basing it off of 20 bars, 20 trading days, right? So that's the standard barometer. So we're going to leave it there because that's the standard for the Bollinger Bands. And then the standard deviation is going to be a -2 and a +2. So the number of deviations to plot the lower band, and then this one would be the number of deviations to plot the higher band. And what standard deviation pretty much is, it's like it's a calculation of the stock's expected move, or another way of saying expected move, you can say like the average true range over a period of time. But the expected move is what the market makers would determine to be the amount that they would anticipate the stock to be able to move to the upside from its current price and from the downside to its current price. And I'll show you the expected move very shortly of where you can find that number, or a number that represents that. I know some people may have other methods of finding that number, but there's an expected move of 2 times to the upside and 2 times to the downside, right? And then the average type is simple. And this is, you have your simple moving average, you have your exponential, you have weighted, Wilders, and Hull. The two most popular are simple and exponential. Simple is like just, the bear case numbers of what it is over the past 20 days. The exponential aspect of it gives it there's a slight change to the calculation, and it essentially gives you some numbers that shows it moving a little bit faster, right? And I don't know the particular calculations, but just know that there's a difference between the simple. The simple is a little bit slow, but not like super slow, and then the exponential is a little bit faster if you want to make quicker, faster trades, meaning like you want to be able to get in faster and exit faster. And maybe we'll throw some lines on there so you can see the difference between the simple and an exponential and just a moving average factor, okay? So let's go ahead, for the purpose of this, keep it simple. Me personally, I am an exponential guy, but let's keep it simple here. So we have our midline that's going to be a particular color. The midline is going to be that 20 moving average. So let's go ahead and change that color to yellow, or this gold color here, so we can see it more. We're going to have it a regular dotted straight line width of 1, and values are numerical. The lower band, they have it as a purple. And again, it's just going to be a straight line style. And the upper band, they have it as a red. So what we can do is, let's change this lower band to, we can keep it as purple, but I don't really like that color per se. So let's make it blue or something like that. Something that'll pop on, you know what? Nah, let's make it white so it can pop for this example. So it's going to show plots, show bubbles, show titles. So lower band's going to be white, upper band's going to be red. Show plot names, show plot, and we're not going to have any of these things. And it has a left access ability, which I'm not too sure what that is, but we're not going to worry about that. So let's go ahead and click OK to set that Bollinger Band up. And the other thing that we already have on here is the volume. And so the volume we have is the average volume. So it's going to obviously put the volume on the bottom that's already here, but then it's also giving me the average. And that yellow line that you see right there is the average on the volume, okay? So that's telling you what the average volume is. It gives you an idea of what's going on in that day, or how it's been performing based on the average to the day's volume, right? And the last thing, let's go ahead and put on here, depending on your style, maybe you may be a histogram person, a MACD person, or you can be a relative strength index, but let's go ahead and put the RSI on here. I think that's a pretty good one to throw on this particular chart, so that you can get the idea of if something's overbought or oversold. And we're gonna keep the length of the RSI is over the 14 days. And so we can change this to match. Again, this is the number of bars to calculate the RSI. 14 days is standard. So we can leave it there. Your overbought is always at 70 for the most part, and oversold is always at 30. It's based on the closing price. It's the Wilder's average type. And then here's down here, when you plot it, is where you can change your lines and colors. So you have your oversold color, you have your overbought, you have up signals, and you have down signals that can show. And so that's going to add another feature down here on the lower end side of our chart. So we have Bollinger Bands. That is pretty much standard. We have the average volume with that 50-day average, and then we have the RSI with pretty much everything standard, nothing unchanged. And so we're going to apply that setting here, and now we're going to see the chart that we have. So here we have, down here we have our RSI with all the settings, seeing where we're at right now. Again, this means that it's essentially like overbought when it gets into this area, and then the 30 line down here at the bottom shows that it's oversold. We have our volume bar that's pretty much unchanged, but the main thing here that we have is now we have our Bollinger Bands. So if you're going to, I'm going to get rid of this line, these lines that you see here. Those are Fibonacci's that I placed on there a little while ago. But what we have here is the Bollinger Bands. And when you're going to trade based off of Bollinger Bands, essentially here, what you have is when a stock or ETF goes on the lower side of the band and it begins to perform on the outside of that band, it would have the likelihood or the higher probability of snapping back within the band. So again, these bands represent 2 times the expected move, standard deviation. So from the mean price, our 20-period moving average, simple, that's yellow, it did a 2 standard deviation move to the downside and reached the outside of its band. And essentially, when it reaches there, it would typically snap back, like a rubber band snaps back when you pull on it too much. So that's what we have here on this following day when it begins to move back up. And then it comes back through its average, and then you see that it starts to come up on the side, and it doesn't necessarily touch its Bollinger Bands here in this area, but it's at a level of resistance. And it reached up a little bit higher, and it didn't necessarily touch the band, but it got pretty close. But due to market news, information, and things of that nature that occurred around February 24th, We see that it did pull from the top side of the band down to the bottom side of the band, and went through its mean down to the bottom side, kind of came through, and then now it's snapped back. We had some recovery on the past 3 days on the Dow. As you can see, the band does expand to wider points and also contracts based on the movement of the stock. So we can see these swings here, which are going to create bigger bands, right? When it swings down from a 26,000 up to 29,000, that's a $3,000, move. So your band does expand. And as you can see here in this gap, it needs to start to fill it up because we begin to have tighter moves in this area. So the standard deviation is shrinking on the bottom side and also shrinking somewhat on the top side, to where in these tight moves, it's coming back to be a tighter band. Other places to kind of take a look at it and see the difference in things. And I'm going to throw up Apple, but I have some lines on here. Let's give it some time to load up. Take a sip of coffee. There we go. So now we have Apple with its bands. These dotted lines that you see here are my trend lines, where I connected to, some support levels and some resistance levels on this uptrend. But you can see the bands here as well, where they're doing their movement. From the top side, we came outside of the band back here, we pulled down, came to the bottom side of the band, and then we worked our way back up. And there's a little drop, and you have these moments of where it's sideways action in the uptrend particularly. And then in this case, you didn't see that it hit the band, but it began to move up, and this is based off my trend lines that I had. And Apple was in a nice uptrend at the beginning of the year, or the end of the year to the beginning of the year. And then you see we got into this area where we were riding the top side of the band. And then of course, when it does that, there's a higher probability that it's going to snap back. So here's kind of the I don't want to call it the difficult part of Bollinger Bands, but there's some things to keep in mind. As you see here, you would kind of expect to see this snap back based off of all this riding on the top bands. And it does do a little bit of pullback, but as you can see, it doesn't always pull back to the bottom of the band. It may just pull back to the mean, to the 20-period moving average, and then increase from there because the stock is in a healthy uptrend. And it looks like it liked the 20 EMA as an area of bouncing. So then as it pulled back up to the top side of the band, rode it for a few days, it pulled back some, but again, not to the bottom side. But you can see there's some expected pullbacks at that time, especially as it was creating new highs at this point. So that'll pull back, and then again, up riding the top side of the band, got really outside of the band, and then this is where we get more of a pullback. So you can kind of see the difference here, where it rode the top side of the band here for a few days and then pulled back, and got back up there for a few days and pulled back, and got back up there again, and now it's heavily moved outside the bands, and it pulled back a little bit more. So think of the aspect of the further you pull out your rubber band from your wrist, if you had it on your wrist, the more it'll snap back, right, to not only the mean, the average, but maybe to the lower side of the band. And then when we see that it did come close to the lower side of the band, but again, on my trend lines that I drew of some support and resistance, not too sure what they said, draw these on. Oh, so I drew this based off of this low and this low for the uptrend to go. And I duplicated my line and dragged it to the top to see some resistance points. And so, but as you can see here, it pulled close to the bottom side of the band, and then it began to work its way back up, this time running heavily outside of the band. Then we get some significant pullback to the mean. And then this is where we had like bond talk and a whole bunch of other type of corrections that needed to occur in the tech sector. And the NASDAQ was hit pretty hard lately. So now you can see that it's riding along the bottom side of the band. And this is where you would say, okay, there's some opportunities for entry because it's riding the bottom side of the band. So we would anticipate for there to be some type of snapback. And of course, there was a little bit of pop here. but then it just continued on this downward trend, not being able to break above the mean. So that's how you can utilize the Bollinger Bands and in this manner of seeing the potential opportunities to buy on the lower side of the band for when it to return up to the top side of the band, or even when you see that it's kind of moving up outside of the top side of the band, that you can anticipate a pullback. So depending on the type of trader that you are, whether you're a long-term trader, or even doing leap options, options that are 1-2 years out, or you can be a swing trader and you're doing options that are 3 months out, 6 months out. You still have to determine for yourself, right? What is going to be your stop out? What's going to be your target points? Because depending on your time frame of you wanting to be in your trade, will depend on your on how you're going to anticipate the reading of the chart. Because if you are a short-term trader, say you want to get into something for 1 to 2 months, maybe 3 months, right here, you would see this opportunity when it pulls back because it's been outside of the band. You don't anticipate being in it for 3 months all the way, out here, but you're going to play this ride back down to its mean, or maybe even back down, depending on if you want to, stomach the sideways move, down to this point of it where it gets close to the lower side of the band. And then you would exit at that point. So you would get a move roughly from 138 down to 127. So about an $11 move on Apple based on the option and strike that you pick, right? And just pick up that profits for that. Let's see, 1, 2, if you got it on this day, that'll be 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So 13 to 14 trading days, which is about 3 weeks. And you would have had a nice movement down. Hopefully you exited right around the lows. Maybe this would have even been a good low, and you go from there. So, and then the same thing on the upside. Now, if you're doing long-term on the upside, this would still be a good buy point, seeing that it's come down, create a lower high. A higher low than its previous lows. And you'd move it to the upside to do a long-term trade, or even again a 2 to 3 month trade, just to play it back to the top side of the band. But then when we come down into this area where you're seeing that it's riding heavily and even going well outside of the bands, and you want to enter into a short-term trade, a 2 to 3 month option, maybe 6 months option or something of that nature. And let's say this is the day that you decided to get in because you're like, all right, look, it's really pulling on the outside of the bands and I'm anticipating to move back up. Well, you would be right over the next 2 days. But this is also the case where you would need to have those stop outs available, because then it begins to retrace and pull back. And you'd have to consider, what news is out there right now, where obviously this is Treasury bond and yield conversation. NASDAQ was taking a hit. All of tech was taking a hit in this case. And you could either stay in because you definitely still have some months, or you would say, all right, maybe I'm going to stop out and wait for it to really pull back and turn around from being on the bottom side of the band. So you really have to come up with your trading plan of how you particularly trade this particular method if you're going to use Bollinger Bands as your indicator for entries, and also still have your information for exits as well, right? You got to have your target of where you potentially exit for profit, or also exit for a loss, right? What are you willing to risk on the particular trade that you get in? So this is just a short video of setting up some Bollinger Bands and some ways of reading it. And I'll share some more videos. Maybe we'll do some think back trades on this, like what this movement would be for profit, and kind of go from there. So until then, just want to share this short video. Until the next time, I want you guys to continue to think, live, and be unstoppable. See you guys in the future. Peace.